Hi, good morning, everyone. Thanks for joining us for our usual weekly Monday morning call. Today we have a few stock counter updates and the usual Singapore weekly. So without any further ado, let me hand over the time now to John to speak about Meta platforms. John, please.
Thanks, Aaron. And good morning, everyone. So like Aaron mentioned, I'll be running through Meta's third quarter earnings, which they announced last week. So just jumping straight in, the main, I guess, the main highlights for the third quarter were obviously re-acceleration in advertising trends, as well as earnings, which really outperformed and grew quite significantly. In terms of your ad revenue, um, ad revenue grew about 24%, which is essentially a doubling in terms of growth rate. So in the last quarter, it grew about 12%, and then the prior quarter was about 4%. So we're starting to see some sort of sustained growth in the digital advertising industry. So it's not just benefiting Meta, but Google as well. So the main thing for Meta is that a lot of the acceleration actually is coming from a lot of outbound China advertisers. So that these Chinese advertisers are actually trying to reach consumers in other markets like the US and Brazil, and are actually mainly coming from e-commerce as well as gaming, advertisers. In terms of monetization for Reels, which traditionally has been a headwind because Reels actually, because it's a short form video platform, it has less ad placements, and naturally it doesn't monetize as well as your traditional stories or feeds kind of format. So what we saw in the third quarter was that Reels is actually no longer a headwind. So they've been able to work through increased monetization for short form video, just mainly due to improving efficiencies as well as adding more ad supply into the platform itself. And what we expect moving forward is Reels to be, I guess, a modest tailwind to revenue growth moving forward, which should be a positive because in the past, as more and more people have kind of are starting to use Reels, it's actually taking away, I guess, time spent on stories and feeds, and so naturally, it just kind of it's been hurting margins as well as hurting revenue growth. But with this no longer the case, it should actually help to boost revenue growth, or at least moving forward, at least to sustain these kind of levels, or maybe even accelerate it as the scale kind of continues to increase. The last point is about margins and earnings. When you look at this red box over here, just looking at operating margins, 40%, significant increase over the prior year. When you look at earnings as well, both operating income as well as PATMI grew about 2.5x, which is very significant, and it's basically the highest margins that Meta has had in over the last 2 years. So essentially, right now it's kind of in line with where it was during the pandemic, which was explosive growth. The main reasons for this is because Meta actually cut about a quarter of its workforce. Has been doing so over the last 12 months. So you get this added effect of top line growth as well as lower expenses, and that's kind of why margins have actually grown quite significantly. The one main negative for Meta, is that they did issue some sort of a very wide revenue growth range for the fourth quarter of this year. So the range was in 36.5 to 40 billion US dollars, which if you take the midpoint is not too bad. It's a 19% year-on-year growth. But if you look at it from the top end to the bottom end, it's like 13% to 24%. So it's a very wide range of guidance, and a big reason for this is because of the ongoing volatility in the Middle East. So then the company's not really sure, how much the conflict will actually affect advertising revenue. I think the worry is that at worst case, it could be something similar to what happened in the beginning of last year when Russia invaded Ukraine, and they got banned from Russia. Although we don't think that this would be the case for what's going on right now. So we do think that revenue should fall somewhere in the middle of that range, maybe at 38 billion, 37.5 to 38 billion range. In terms of the outlook for next year and expenses outlook for the fourth quarter and next year, Meta also said that they're going to be continuing to increase a lot of investments in AI infrastructure, given that they use AI a lot for improving their performance in advertising. And then obviously over the last year, when they kind of focused on efficiency. They essentially cut a lot of their spending just to essentially get their margins steady again. But right now, as we see revenue continuing to grow again, Meta is also expected to increase their total expense growth. So for 2024, they expect total expenses growth to grow about 10%, while capex to increase about 16%. Well, this is kind of in line with what we expect as well. So we don't really, we haven't really had to make any adjustments to our forecast for next year. In terms of our recommendation, we actually upgrade Meta to buy from an accumulate. We raised our target price from $360 to $375 because we raised our revenue for this year by 2%, as well as we increased our EBITDA and net margins by about 1%, mainly due to I guess increased efficiency as well as added digital advertising growth. We do expect Meta to benefit from the digital advertising recovery, like I mentioned earlier, and sustain these 30+% margins moving forward. And that's essentially one of the major reasons why we've upgraded it to a buy. So that's all for Meta. I'll move on to my next counter, which is Alphabet. They also issued their third quarter results last week. Similar story for Alphabet. Big thing is sort of a rebound in advertising growth as well as margin growth, although the results weren't as significant as Meta's. Most of the results were just good across the board. When you look at revenue grew by about 11%, so some sort of acceleration, but still in your low teens range. Not like Meta, in the 20+% range. A big reason for the rebound is I guess increased contribution from search advertisements as well as YouTube advertisement ads revenue. A lot of it was a bit driven by retail spending as the US consumer remained fairly resilient, and a lot of advertisers are actually prepping for a longer holiday season, which is essentially Q4 this year. In terms of margins did expand a little bit on higher operating leverage, so net margins were fairly healthy. Although margins didn't really expand as much as Meta's because they didn't actually cut as aggressively as Meta. So you don't really get to see this huge change in margins. But either way, they're still operating fairly well. Operating margins were also fairly healthy. The main negative was actually cloud growth, and you see even here, even though cloud grew about 22-23% year on year, which is very healthy, I think there are not really that many businesses that can grow, at 20+% range. When you compare it to some of its competitors like Azure and AWS from Microsoft and Amazon, it was essentially the worst of the three. So in theory, they were losing some sort of market share to its competitors. Looking at Azure, it grew I think to almost 30% year on year, while AWS remained fairly stable, I think in the mid to low teens. But just because Azure and AWS have a much higher base in terms of revenue, so growth is essentially they are still taking away share from Google Cloud. In terms of what we expect moving forward, we expect revenue growth for the fourth quarter to accelerate just because historically, traditionally, the fourth quarter has been a stronger quarter, mainly due to the holiday season, so more and more people are advertising because people just buy more things towards the end of the year. We do expect earnings to actually grow quite a bit for the next quarter, so increasing from a 42% growth rate to about roughly about a 60% growth rate. A couple of reasons for this, mainly because the fourth quarter of last year was a really low base. It was the beginning of their cost-cutting measures, so they actually had to incur a lot of severance-related and optimization costs in their fourth quarter of last year. So that's the main reason why there's such a big jump in terms of year-on-year growth rate for earnings. In terms of capex level and total expenses spend, it's fairly similar to Meta. They're going to, because of AI, they're going to invest a little bit more aggressively in AI. That's kind of driving up a bit of their expenses. In terms of our rating for Alphabet, we still maintain a buy rating with the unchanged target price of $144. Mainly because a lot of the expenses spend and revenue growth is in line, and we haven't really changed any of our assumptions for this year as well as for next year. We still think Alphabet is still essentially the main driver of digital advertising. you're not really going to go anywhere else if you're an advertiser. So we think that with their leadership position, they're going to be maintaining it through more investments in AI and delivering better results for advertisers. So that's why we maintain our buy call on Alphabet. So that's all for Alphabet. I'll move on to my next counter, which is Spotify. The key themes for Spotify is increasing user growth, as well as profitability that seems to be kind of close to an inflection point. In terms of user growth, like total monthly active users, MAUs, and premium subs, this number grew quite healthily by 26% and 16%. And the key here is the key is in user growth because Spotify is still kind of in its scaling phase. So it's still trying to get more and more members onto its platform because it has quite a high fixed cost base. So when it comes to how they do their costing, they have a lot of expenses every year when it comes to licensing music as well as podcasts and audiobooks. And so when you have this kind of high fixed cost base, you really kind of need to reach a certain level of scale before your operating leverage kicks in. And what we think is that Spotify is actually very close to this when you look at some of the results like operating income as well as profitability outlook. They're definitely trending towards being at least a profitable company on a full year basis instead of just maybe 1 quarter here or 1 quarter there. And obviously the biggest reason is because they've hit your 200 million user mark, which is key not just for Spotify, but if you take a look at other companies like Netflix, once they've reached about 200 million, that's kind of usually when they start to see a sharp increase in operating leverage. And so because we think that Spotify has kind of obviously passed that mark and expected to kind of continue growing, we do think that profitability will improve moving forward. In terms of outlook for the next quarter, we expect about 17% revenue growth. This is because they raised their prices in more than 50 markets sometime in the middle of the third quarter. So you don't really get the full effects of the price hikes in the third quarter. Essentially, you only get about a 1 month price hike recorded, whereas in the fourth quarter, you'll get a full quarter of price hikes, and that will show in the top line as well as the bottom line. And that's kind of why I guess margins are also expected to kind of improve sequentially as well. In terms of our recommendation for Spotify, we maintain an accumulate rating, but we actually raised our target price from $162 to $190. Mostly in part because we raised our EBITDA forecast for 2024 by about 42%, or about 161 million euros. And the biggest reason for this is due to profitability. I guess not so much returning, but improving. In terms of why we think Spotify is accumulate and it's a good buy, we think because they are the leader in your audio streaming, I guess platforms. It is much better than some of its competitors like Apple Music or YouTube Music, just based on scale as well as the kind of offerings that they have. It's not just audio, but it's not just music, but audiobooks and podcasts as well. And we think that they'll continue to invest heavily in their platform, and once they reach a scale, which they are kind of reaching right now, it should be we should be able to see quite a significant margin expansion moving forward. So that's all for my counters. I'll hand it over to Ambrish for Microsoft.
Thank you, John, and good morning, everyone. So last week, we released a report on Microsoft's first quarter results with the title Azure Growth Reaccelerates. So overall, the first quarter results were in line with our expectations, with revenue and PATMI coming in at 24% and 26% of our full year 2024 forecasts. And in terms of its positives, total revenue, it grew by about 13% year on year. And it was largely driven by its intelligent cloud segment, which contributes about 30% of the overall revenue. And it includes the popular its cloud service Azure. So Azure revenue, it grew by about 29% year on year in the first quarter, and it reaccelerated from the sequentially from about 26%. And the management highlighted that the growth, it was mainly because of increasing shift of workloads to the clouds, as well as the growing contribution from AI related services. Secondly, Microsoft, it has a 90% market share in productivity market software. And despite the significant market share, there is continuous demand for its Office 365 software. And as a result, Office 365 commercial revenue, it grew by about 18% year on year. And the demand, it mainly came from small and medium enterprises and front-end worker offerings. And there was a rising need to manage tasks. And the company highlighted that for Office 365, the number of paid users, they grew by about 10% year on year in the first quarter. And it reached about 400 million commercial users. And it also saw increase in revenue per user, mainly because the enterprises, they upsell to its higher end E5 license for its better cybersecurity upgrades, mainly because of its more functionalities. And lastly, Microsoft, it reported operating margin of about 48%, and this was the highest in over the last decade or so. And this was mainly because of continuous the cost-cutting initiatives. And the management, it highlighted that its headcount, it actually dropped by about 7% year on year in the first quarter. In terms of its outlook for the second quarter, company said that its revenue, it's expected to grow by about 15% year on year. And this would be again driven by Azure and Office 365, with a slight deterioration for Azure revenue growth by 1%. And this should be mainly because of the ongoing optimization trends, which it should continue to witness in this quarter. And we believe that the Office 365 revenue, it should continue to grow in double digits, mainly because in this week, company, it's expected to commercially launch its Office 365 AI tools, and this should provide a boost to its revenue. For instance, it's an AI tool, like it could generate the first draft of presentations, or you can even generate the text in the Word, and this should provide a boost. And the companies said that in the beta version, it's gaining traction. And also in the second quarter, company said that its gaming segment revenue, it's expected to grow by about 40% year on year. And the contribution from Activision Blizzard acquisition, it should be about 35% of this, which comes to about $1.7 billion US. And for the full year 2024, the management, it maintained its operating margin. It reiterated its previous guidance that it should remain flat for the full year operating margin to about 42%. And this was mainly despite its acquisition of Activision Blizzard. And the capex, it should continue to grow sequentially throughout the year, mainly because of ongoing AI investments. So in terms of valuation for Microsoft, we maintain our accumulated recommendation. However, we slightly increase our target price to 375. And this was mainly because we increased our full year 2024 revenue and PATMI by 2% and 0.4%. And the 2% revenue, growth was mainly because to reflect the Activision Blizzard transaction. And overall for Microsoft, we believe that it's well positioned to benefit from shifting of workloads to the cloud, as well as higher adoption for its AI related services. And in the near term, it should also benefit the Activision Blizzard transaction. It should also help Microsoft to boost its gaming segment revenue. So that's all for Microsoft. I would now like to pass on to Max for Amazon.
Yep, thanks, Ambrish, and good morning, everyone. We have also published a report on Amazon's third quarter results. So here are some of the highlights. Overall, the third quarter revenue was in line with our expectations, but their earnings has exceeded, and this was mainly because of the higher than expected gross margin, as well as the lower than expected operating expenses. So yeah, jumping straight into the positive. Firstly, is that Amazon's margins continue to improve. Both the gross margin and operating margin expanded quite significantly year on year, with the operating income more than tripling year on year, and it also beat the company's own guidance by more than 30%. So why this happened is because the retail business benefited from the lower overall cost to serve, and this was as a result from its fulfillment network regionalization in the US, as well as the fact that Amazon is facing lower inflation on shipping rates as well as energy costs. And furthermore, what helped the margin expansion was the continued strong growth of its advertising business, which grew by 26% year-on-year, and the advertising actually made up about 7% of the total revenue. Then for the AWS itself, the operating margin has also expanded by 600 basis points quarter-on-quarter and 400 basis points year-on-year, and to a level that was last seen in the second quarter of 2022. So the AWS margin expansion was mainly driven by the headcount reduction in the department, as well as the lower energy costs. Then moving on to the second positive is that AWS growth seems to have stabilized. So revenue was up by 12% year-on-year, and this was the same as the previous quarter, and it was also in line with our previous view that the growth has bottomed out. So management said that although the customer cost optimization efforts are still elevated compared to 2022, it has meaningfully eased, and more customers are actually diverting their attention more towards deploying new workloads. Then for AWS, the business also signed several new deals with both existing and new customers that will take effect in the fourth quarter as well. So, so some customers have actually decided to expand their AWS deployment, and some of them decided to move away from short-term contracts like per hour on that is based on hourly rate to a longer-term commitments ranging between 1 to 3 years. So this is kind of a positive sign for AWS because it shows that the pipeline remains strong. Then for the third positive is that the company yet again generated another strong free cash flow. So for the trailing 12 months, free cash flow was at $21 billion, which meant that it tripled quarter-on-quarter, and it was also a $41 billion improvement year-on-year. The reason for the strong free cash flow was again the increased operating income across both retail and AWS segments, as well as the improved operating leverage and better working capital efficiency. Next slide, please. Yeah, there was not really a negative that we identified from the earnings call. So we'll jump straight into the outlook. For the fourth quarter, Amazon guided for revenue growth of between 7 to 12% year-on-year, and management has reiterated that it will be spending a capex of $50 million for FY23, which is again similar to the previous to the plans that they announced last quarter. Is below the $59 billion they spent in FY22. So again, the spending cuts will be mainly coming from the initial plan of building fulfillment and transportation networks, but some of that will be offset by the increased spending on AWS to prepare for better generative AI and large language models capabilities. Then, okay, aside from the margin expansion, the regionalization efforts in the US also increased the delivery speeds. So Amazon said that the increased delivery speeds is also a driver for revenue growth, mainly because customers like faster delivery. So because of the faster delivery speeds, customers considers Amazon more frequently than they used to for their shopping needs. And again, and ultimately this drives the revenue growth. And then lastly for AWS, because of the factors mentioned just now, which is the easing cost optimization efforts, as well as the new deals signed, as well, and again also the continued strong pipeline moving forward, we can expect AWS growth to re-accelerate in the near term, possibly as fast as soon as the next quarter as well. For our valuation, we maintain our buy rating on Amazon with a raised target price of $190 using a WACC assumption of 6.4% and terminal growth rate of 5%. We increased our FY23 revenue assumption by 2% and PATMI assumption by 31% to account for the higher than expected operating leverage. So why we like Amazon is because it is still the leading e-commerce platform in the US, or if not globally, and it is also the leading cloud computing cloud service providers in the globe globally as well. So with the trend of moving towards shifting the workloads to the cloud, as well as the generative AI trend, we believe Amazon will be one of the few companies to benefit from this trend as well. So yeah, that's all for me. I hand over the time to Glenn to talk about UOB. Thank you.
Thanks, Max. Yeah, so for UOB, they released their third quarter earnings, and their adjusted earnings of 1.479 billion was slightly above our estimates, mainly due to higher fee income as well as higher net interest income, offset by lower than expected other non-interest income growth, as well as higher allowances. So their 9 months 23 adjusted PATMI was at 77% of our FY23 forecast. I'll jump straight to the positives, being the first positive is that their net interest income and net interest margins continues to grow year on year, and the net interest income grew 9% year on year. This is despite a decline in loans growth of 2% year on year, while their net interest margins rose 14 basis points to 2.09%, but it did decline 3 basis points quarter on quarter, mainly due to the lower margin on excess liquidity. For the loans growth decline, it was mainly from Singapore and Indonesia and offset by growth in the rest of ASEAN. For the second positive is that their fee income recovers to near an all-time high, and their fees actually grew 14% year on year, largely due to higher credit card fees, which hit a new record of 104 million. So the credit card fees rose 89% year on year, while there was also broad-based growth across their loans-related fees as well as wealth management fees. And on quarter-on-quarter basis, the fee income also did rise. It rose 13%. And fee income now makes up about 17% of their total income as at third quarter 23. For the third positive is that their new NPA formation, it fell by 27% quarter-on-quarter as the asset quality stabilized during the quarter. And the NPL ratio also remains stable Q-on-Q, but it did rise 10 basis points year-on-year to 1.6%. For the negatives, first negative is that their other non-interest income growth was flat year-on-year, and it also declined quarter-on-quarter. It was flat as the customer-related treasury income had sustained momentum, but their trading and liquidity management activities continued to deliver good performance. But it fell quarter-on-quarter mainly due to the growth in the customer-related treasury income being more than offset by the lower valuation on investments due to market volatility. For the second negative is that their credit cost has increased mainly due to higher specific provisions, despite their general provisions write-back. So their total allowances rose 12% year-on-year to 151 million, mainly due to the specific allowance increasing by 80% year-on-year to 229 million. Although there was this general allowance write-back of 78 million for the quarter. And this increase in their specific allowance was mainly a preemptive move made by UOB to rebalance the collateral value in their US and Hong Kong, China segments. Though they said that actually all these accounts that they had rebalanced were not distressed or non-performing, but it was more like a proactive move. So this resulted in the credit cost increasing by 2 basis points year-on-year to 19 basis points. For the last negative is that the expenses was up 4% year-on-year, and this increase was across the board, including their staff costs, revenue-related, as well as IT-related expenses. But if you look at their cost-to-income ratio, it has improved by 1.6 percentage points year-on-year to 41%, mainly on the back of strong income growth. So for the outlook, I mean, we will just look at the forecast and the guidance that they have provided. So for their PATMI, we believe that UOB's profit should continue to grow into 2023 as well as 2024 on the back of stabilizing margins, stronger fees, and lower provisions. And they have mentioned for their guidance for their things that affect the PATMI would be loans growth, NIM, and fee income. So we look at firstly at the loans growth. They said that they provided. So for FY23, the guidance has been roughly similar, but for FY24, they provided this new guidance. So they did provide a mid-single-digit loans growth guidance, and mainly from a growing customer franchise and focus on high-quality customers. So this is sort of slightly above our mid to low single-digit forecast for FY24. And for NIMs, they've also mentioned that they have guided for it to remain at the current levels as the funding costs have stabilized and expectations for rates to maintain at these current levels to the second half of 24. This also matches our forecast for FY24 and for NIMs to maintain at the current levels. For the fee income, they did say that they do expect double-digit fee income growth from the Citi acquisition, and this is above our forecast and expectations of a mid-single-digit, single-digit fee income growth for FY24. They also said they do expect stable cost-to-income ratio as well as credit costs at around 25 to 30 basis points. So this is quite unchanged. And I think the growth drivers for UOB would be as NIM maintains at the current levels, the net interest income shouldn't dip as much as we should expect. And also, the driver will mainly be for them the fee income growth. So this will come from the Citi acquisition and the current partnerships they have with all the concerts such as Taylor Swift and Ed Sheeran. So this will not only just attract at one time for customers to use UOB to buy the tickets, but also to try to retain this customer base. So that's how I think they're also looking to grow their loans growth. So loans growth, they're looking at around mid-single digit, and this will further grow their net interest income, resulting in a overall growth in their earnings. So as such, we maintain a buy with an unchanged target price of $35.90, and our FY23 estimates remain unchanged. Now moving on to iFast. Yeah, thanks. For iFast, so it's just to highlight that it's not rated, and this is just a Phillip on the ground. We'll just do a brief overview on their third quarter 23 earnings. So for third quarter, their assets under administration, it grew 1.7% quarter-on-quarter, but 12.6% year-on-year to reach an end of quarter record high of 19.12 billion. And this came from as the net inflow of client assets remained positive, and it rose 34.4% Q-on-Q to 751 million. For their revenue, it grew 23.8% year-on-year to 66.22 million, with net profit positive and surging 308% year-on-year to 8.52 million in the third quarter. And this also was a result of, this was due to the non-banking net revenue was increasing 38% year-on-year, with net profit up 150%. For their banking business, the net revenue was actually up 50% to 3.32 million, but they did still post a net loss of 2.1 million. This is slightly better than the loss of 2.2 million a year ago. So their interim dividend is maintained at 1.3 cents for the third quarter. So we'll look into the two main topics which they've been talking about quite a lot recently, which is their Hong Kong e-pension business as well as the iFast Global Bank. So for the Hong Kong e-pension business, they have not changed their targets from April 2022. So it has been maintained at the same levels since for about a year, more than a year already. But I think the targeted time frame, the comments onboarding, I think they mentioned more specifically that it will be in the second quarter of 2024 with full operations in 2025. And they also, with the launch of their also e-pension service in late June, so it was quite recent, a few months ago, they do expect that this will continue. This also will start to make sizable contribution to Hong Kong's AUA from the first quarter of 2025 onwards. And this will, of course, increase their revenues as well as profits for the iFast Hong Kong business. So I think, we have also done a few sort of quick calculations on how this e-pension business will affect their PE. So if you just, all else assuming the same, we have included what they have guided for 2024 as well as 2025, and we have come up with their PE will be around 31 times in 2024 if you include the e-pension business, and 23 times in 2025. Yeah. So now moving on to the next segment, which is the next part of their what they've been mentioning recently is the iFast Global Bank. So just a few details on this global bank. They have opened this, they have acquired this bank in UK, and the main aim is to enable customers from all around the world to open a UK digital bank account conveniently online without having to be physically present in the UK. And they also can open in multiple currencies. And what they have mentioned is that they have received the bank account opening applications from over 50 different countries on their digital personal banking platform. And the current product offerings for this digital personal banking would mainly be just quite basic. So it'll be a basic bank account, fixed term, and notice deposit accounts across multiple currencies. And they can actually switch, so it's like a multi-currency account where you can switch the currencies between accounts, quickly. So they also do expect it to continue to be loss-making in the second half of 2023. But one of the positives would be that their customer deposit amounts have surged 100% quarter-on-quarter to roughly 232 million Sing dollars. And this was mainly due to the digital transaction banking customers depositing safeguarding funds. Yeah, so that's all I have for iFast and for the banking sector. I'll now hand it over to Meow Meow. Thank you.
Thank you, Glenn. So Suntec REIT released the third quarter 23 business updates, which in line with our expectation. Gross revenue grew by 15% year-on-year, but DPU declined by 14% due to the higher financing costs, FX fluctuation, and higher maintenance fund contribution. Good things about Suntec is the office occupancy rate remain resilient at 97.4%, and retail portfolio stands at 97.9%. Suntec City Mall achieved a rental reversion of 20.2%, and we expect the rental reversion to continue trending upwards for the retail sector, around 10 to 15% in FY24. And this is able to partially offset the negative impact brought by the increasing financing cost to around 4.25% in FY24. Moreover, Suntec's convention center revenue surged by 87.3% year-on-year, and is expected to make full contribution in FY24. Not much of the concerns is on the high gearing. Suntec is committed to the current divestment plan, aiming to sell the strata units worth 100 million by the end of this year. Now around 40% is completed, with price 20% above book value. This is likely to reduce the gearing by 100 BPs, providing a buffer against the potential year-end valuation decline of the overseas asset, while Singapore market forecasts no change in cap rate. Gearing is expected to remain below 45% threshold. For negatives, stress is mostly on the overseas market. UK overall occupancy rate dropped at 6.5% year-on-year, and Australia slided 1.2% quarter-on-quarter. Leasing momentum in UK and Australia market were crippled by the cautious economic outlook. As for outlook, we expect Singapore market to be the key revenue driver, with double-digit rental reversion for the retail side and high single-digit for the office sector in FY24. There is no change in our FY23 forecast. We lack Suntec mainly due to its cheap discounted NAV compared to other Singapore REITs, and now is trading at 0.52 times price to NAV. We believe much of the downside risks have already been factored into the current share price. As such, the DDM-backed TP remain unchanged at $1.47, with the FY23 to FY24 DPU of 6.68 to 7.87 cents. Next slide, please. Moving on to Far East Hospitality Trust, we conducted a Phillip on the ground. We don't cover the stock, so it's not rated. Gross revenue for third quarter to 3 increased by 42.5% year-on-year to 30.2 million, primarily driven by higher contribution from hotel segment, which increased by 56% year-on-year. The DPS in third quarter to 3 was 1.12 cents, and the 9 months to 3 DPS stands at 80% of the entire FY19 level. And Far East intended to use the divestment gain of Central Square, which was 18 million, to mitigate the impact of potential higher interest expense, and the targeting of full-year dividend yield of 6% in FY23. Occupancy rate are ramping up quickly for hotels that have recently exited the government contract, such as the Oasia Hotel Novena. Also, the Village Hotel Albert has entered into another government contract, will be extended till the end of this year. And the contract is based on full occupancy rate and rate at market level. Forward booking for FY24 appears healthy at this point, driven by strong event-driven demands. RevPAR is expected to continue trending upwards in FY24. Now is 5% above pre-pandemic level, but occupancy rate is still at 95.7% of pre-pandemic level. ADR is at $173 and supported by resilient demand from corporate travelers. Far East is looking at a small to mid-size acquisition around 70 to 80 million in Japan, and is highly likely to be done early next year, with a positive carry of 2%. And gearing as of now stood as 32.2%, providing a debt headroom around 450 million Singapore dollar. Yeah, that's all for me. I'll hand over back to Darren.
Yeah, thanks, Mel. Yeah, so Frasers Centrepoint Trust, they released their results last week. So this is the FY23 results. So for the FY23 results, it was in line with our estimates. So excuse me. Yeah, so the gross revenue of increased 3.6% due to higher occupancy, as well as gross rent and atrium and car park income as well. So the atrium income started contributing last year around April. But the gross revenue was partially offset due to Tampines 1 going through the AEI. So some of the portion of the mall is going through AEI, so it's not contributing. Yeah, but the Changi City Point still contributed a full year cost. The divestment is not complete yet. And as a result of this higher finance cost, which grew 70% year-on-year, the DPU is down slightly by about 1%. So for the positives for these results, the retail portfolio occupancy is nearly full at 99.7%. So this is really almost full, and it's hard to improve any further. So quarter-on-quarter is up 1%. And the good thing about this is that rental reversions for this full year is came in at about 4.7%, and for next year they have about 29.3% of leases expiring, and we expect that rental reversions for next year for this 29.3% will remain similar at around this 4% levels. And for the FY23, the tenant sales and shopper traffic is still resilient. It grew 7.3% year-on-year and is up 24.7% year-on-year. And things like the increase in population also will help to maintain this tenant sales going forward, as well as shopper traffic. The retail portfolio valuation increased 0.6%, so it's relatively stable despite interest rates rising. The cap rates are unchanged. So this just shows that the retail valuations in Singapore, asset valuations in Singapore are very stable as compared to overseas assets where cap rates expand and see valuation declines. And the last positive for them is that they have refinanced all their financing risks as of their expiring loans as in FY24. So their FY24 loans, they refinance to FY29. And for their capital management fund, they have 63% of debt hedged. And currently their cost of debt is at 3.8%. And after they refinance this, their cost of debt is likely to creep up to slightly above 4% in FY24. And this is despite using the divestment gains of Changi City Point and Hector REIT. They divested their stake in Hector REIT. So they are going to use this two divestment proceeds to pay off the debt that's on highest interest rates of about 5%. So that will help to kind of mitigate the cost, but the expected cost for FY24 is still around 4% after taking all this into consideration. So their current gearing is now 39.3%, but after the repayment of all these higher interest loans, the gearing is expected to drop to 36%. So for their outlook, the low occupancy cost right now is at about 15.6%. The average is about 17 to 18% historical, and we expect this low occupancy cost and the tenant sales growth, although we think it will slow down, but it will still probably be in the single digit. That's our expectations. So we expect all this to support rental reversions going forward. And during the year, they did 4 transactions, and further inorganic growth opportunities for them will include this acquisition of the sponsors pipeline of assets, such as the 24.5% stake that they have in Next, as well as the North Point City South Wing. And right now, Tampines 1 AEI is 94% pre-committed, and the first batch of their AEI units is expected to be completed in November 23, and the tenants will start moving in gradually from December this year onwards. But the full completion of the AEI is expected to be next year, and end of next year, 4th quarter. Yeah, one thing I missed out is that the negatives for FCT is that we expect higher operating costs going forward. So from higher property expenses as well as manpower costs. So we expect this to affect margins, and we think MPI margins might drop to around 70% levels, so slightly above 70%. Right now it's about 72%, 73%. Yeah, so with that, we maintain our accumulate call on FCT with a lower TDM target price of 2.29 after we account for the divestments that they made and the acquisition, the divestments that they made this year. And right now, FCT, they're trading at a DPU yield of about 5.9%. Yeah, so the next slide is just some highlights on the CICT's results. Yeah, so we do not cover them. So CICT is Singapore's biggest REIT, 11.58 billion. This is a commercial REIT focused mainly on Singapore assets. So for the 3rd quarter highlights, no financials were given. So only the top lines were given. The revenue was up 4.6% year-on-year, and MPI was up 0.6%. but they didn't give the distribution level, so we expect that to kind of decrease because of the higher financing costs as well. So the cost in debt increased quarter on quarter to 3.3%, increased 10 basis points, and right now 78% of them of their debt is on fixed rate. So they improved their performance operationally. Their portfolio occupancy increased for both their retail segment and the office segment. So their retail is now at 99%, improved 0.3% quarter on quarter. The office segment improved 1% quarter on quarter to 96.4%. And for the quarter, both their retail and office came in positive rental reversions. So for retail, it was 7.8% positive rental reversions year on year. And the Orchard, the downtown malls, their reversions came in slightly higher than the suburban malls because of better, stronger recovery, especially from the return of international visitor arrivals. The tenant sales was up 4% year on year, and the shopper traffic was up 12.9% for the year. And it's the same thing for both. So basically, the downtown malls, the tenant sales and shopper traffic also, their growth improved slightly higher than the suburban malls growth. Yeah, so for the office sector, we expect the rental reversions for them this year was 8.8%. We expect it to remain around as mid-single digit going forward. And a lot of investors are worried that WeWork might leave or might end their vacate the space. But right now, there's still no issue with WeWork for now. They have no rental arrears for them, and WeWork is the second biggest tenant for CICT, contributing 2.4% of their GRI. So the outlook is also that tenants are looking to stay amid a cloudy macroeconomic outlook for the next 12 months. This can be seen from their 90.4% tenant retention rate for this quarter. And then I put two charts on the right. So basically the top right chart is the rental for suburban versus office. You can see that the rentals for the downtown area, the Orchard Road area, is year on year is increasing higher now than the suburban, but suburban is still remains resilient. And for the bottom right is the Grade A office rents, the average. So CICT, their average passing rent is still lower than this average market rent. So we expect rental reversions, positive rental reversions going forward as well. Yeah, so we also expect valuations to remain stable in Singapore for their portfolio, but we expect valuations decline for their Germany and Australian office assets with an expansion in cap rates. Yeah, so CICT is now trading at around a 6% dividend yield. Yeah, so that's all from me. I have time to Peggy talk about China Aviation Oil's initiation. Thanks.
Thank you, Darren. Good morning. We initiated China Aviation Oil. Some background is it supplies imported jet fuel to the civil aviation industry in China. It's 51% owned by the state-owned China National Aviation Fuel Group Limited. This state-owned company has the mandate to supply all jet fuel requirements in China. And CAO is the arm that source jet fuel from outside China and send them to the international airports in China. Okay. The CAO also owns a 33% stake in the Shanghai Pudong International Airport, the aviation arm, aviation fuel supply arm. And this short form SPIA, it accounts for 62% of the net profit in FY22. Okay. The key reasons why we think we think it's a buy. The international passenger traffic in China is up 18-fold in the first 9 months of this year on year. But still at the total level is still at 33% of the pre-pandemic level. And we expect this travel volume recovery to gain pace in FY24. That will drive the demand for jet fuel at international airports. China jet fuel consumption has been rising at 8.4% over the last 10 years. If we exclude the year 2020, when pandemic affected the air travel, the growth is still about 9.7% for jet fuel consumption in China. So the number of airports is also growing in China. at 3.4% 10-year CAGR. And we think CAO is now currently supplying to the five out of the top 10 international airports in China. There's room to expand this footprint to the other international airports in the other China city. We expect the earnings to double in the next 2 years. That at the current market cap, 64% of the current market cap is cash of about 49 cents per share. You will notice an EV/EBITDA of negative 0.8 times in FY24 in this table here. That's not because EBITDA is negative, it's because the net cash itself is already higher than the current market cap. We projected to be in FY24. Can I have the next slide, please? Thanks. Okay, just some charts to show our thesis. Okay, the international air passenger traffic has spiked since the beginning of this year when the borders opened for in China, as they allow air travel to resume. There's 18-fold in the first 9 months of 2023. And the number of aircraft movements for the 5 international airports that accounts for the bulk of the China aviation's volume, the number of aircraft movements is still about 30% of pre-pandemic level, which is in FY19. So we see room for that to recover very sharply in the next 2 years. Next slide, please. Thanks. And jet fuel price has actually recovered since the beginning of this year. It dipped about 25% year on year in the beginning of this year, but has recovered along with the higher crude prices. Jet fuel prices no direct impact on CAO. CAO operates on a cost plus basis. Whatever the cost price that they secure for the fuel, they add on a predetermined margin that they have agreed with the airlines, and the ASP is based on the cost plus this margin. So there's no direct impact on how the jet fuel moves. Doesn't have a direct impact on them. The volume counts more, but the high jet fuel price does give some advantage in terms of in the situation of contango, where the future price is higher than spot price, and CAO typically has a price opportunity here, because one is they had storage capacity held at the associates level. This storage capacity will then allow them to take advantage of a price differential. The other thing is with their strong balance sheet of a very high net cash, they have ample liquidity to take advantage of the arbitrage situation. The China jet fuel consumption has been rising at 8.4% on the right chart over here per annum from 2011 to 2021. We don't have the number of 22, but we think from the aircraft movements numbers, we think it's about flat from 21, and there'll be a growth from 23 onwards. If we exclude the FY 2020 when there is a drop, the growth is still about 9.7%. Next slide, please. Thanks. Okay, can I have thanks. So the CAO volume we project to return back to FY19 level in FY25 at about 37 million metric tons. This is the volume that they supply for both into the airports as well as on their trading business. Then for RIC, they used to do very well in FY19 pre-COVID level. They was about above 20%. We think they will come back to this level in FY26. As you will see the recovery gradually from when volume picks up, they were able to enjoy a better net profit level. That's all I have for China Aviation. I'll pass on to Paul for the Siong. Thank you.
Yeah, thanks, Maggie. We just move on to Siong results. Next slide. So for the results, the third quarter results was within our expectations. I think the highlight for us was the positive was the same store sales. So same store sales is basically the older stores. I think maybe 2 years and older, which was where we saw a pickup in revenue or growth. Although it's just inching up, I wouldn't say it's very strong, but it's inching up from 1.5 to 1.8% year on year. The other positive was the new stores. So new stores is mainly where they get most of the growth. So if you look at the table here, the revenue there, you can see that the new stores grew about 2.2% year on year. So most of the growth comes from new stores, and that's getting better because during the pandemic, as you recall, HDB didn't award any new stores, but now it's ramping up. So there's 3 pending. They secured 2 this year, so there's 3 pending award for the rest of this year, and in the next 6 months, there's another 5 more in the pipeline. So there's going to be a positive because they can drive growth. Otherwise, same store sales, not like a lot of people do a lot of grocery shopping. So there's normally maybe 1-2% growth only. The negative for them is the operating expenses. So this is not unique to them. I think a lot of companies are going to face this too. But if you look at the EBITDA line, you see the electricity jump almost 3.9%. So this is huge. If you look at the 49, so you're talking maybe about in terms of operating expenses, about 3 to 4 percentage points at least, and the absolute number is huge compared to the EBITDA. So, and I think a lot of companies are going to face that too. The higher salary you see, the 2.2 is also because of the progressive wage model. So they also they kept up the wages for the lower levels and across all the staff because of the new progressive wage model. In terms of the outlook, there's no change in our forecast, but we did lower our target price from 198 to 180 because we brought down our PE multiple target because since the recovery, the valuations have kind of derated. I think people are less optimistic of the growth, so the valuations tend to average 22 times PE. Now it's trending down to 20 times, so that's our new target price valuation. In terms of outlook, we think there's better visibility of earnings growth next year. Firstly, of course, new stores, and as you pile up the new stores, it will help to contribute growth in the future years. Second is also we think utility expenses is expected to drop almost 20% next year. So that's going to be a positive. As electricity, you can see from the EBITDA is almost 10% of EBITDA. So any decline will also help grow earnings. Interest income also grew, although we normally don't talk about interest income, but now the interest rates are so high. If you look at this line here, net finance income, you notice that actually most of the earnings growth came from net finance income. But anyway, let's not tell everyone that. But the net finance income jumped almost 2 million. And I think this is going to be one growth driver for a lot of cash-rich companies. And of course, gross margins are so stable because they are sourcing better opportunistically, and also structurally, they are doing more private label sales. Where private label means they put their own Siong brand, but they don't call it Siong, they call it something else, which I kind of forgot actually. But that's one other growth area because the margins are better for that. But the main margins for them is always the fresh products like fruit, vegetable, meat is always the area where they do best in terms of margins. So we maintain a buy, the ROE yield, and also net cash. Next slide. Move on to the usual macro. There wasn't much macro for Singapore, but a lot of it came from the residential property news. So the URA releases every quarterly updates on the residential market, updates on the office, industrial, and so forth. But I just focus on residential. Firstly, volumes are down, so which isn't good for real estate agents. But the third quarter volumes dropped about 15%. The new launches volumes or transactions down 11 and secondary down 18. We were surprised. We thought it would be better, but I think continues to slide post the cooling measures. Inventory came down a little bit, but it's still around 2.8 years, and the average is about 2.6. So the inventory has piled up back quite fast. I wouldn't say it's very elevated, but it is climbing back up. So and it wasn't like in the past where the inventory to sales was only like 1 year, only like 12 months of inventory. The other good news is still hospitality, that, as was mentioned by Myanmar, by Frasers Hospitality. The RevPAR continues for Singapore to be a record. So RevPAR is you take room rates and then you times occupancy. So again, it's another reflection of sales. That continues to climb 15%, a bit slower, but it's still at the record levels. So occupancy was down, but actually the average room rates is in Singapore, which is a record. And this is average, this is not the high, this is the average rate. It's about $325 per night you want to stay in Singapore in September. I guess probably the F1. In the US, the important core PCE, which the Fed is always trying to target at 2%, but it's trending down. That's the good news and within expectations. Services is the main one that's pushing out inflation. There's some news on corporate capex, so they also improve a little bit. Next slide. So in terms of our tactical views, where we will share every week, the most important event probably will be the FOMC meeting coming up on 1st of November. We think similar to the futures market, we are not expecting any rate hike even for November or December. Because one of the reasons is that the bond yields, the 10-year bond yields have climbed up 50 basis points since the last FOMC meeting. So in a way, the treasury market or the bond market has already kind of did the rate hike for the Fed. I mean, 50 basis points is almost like 2 rate hikes for the Fed. But the other negative thing of the climb in the treasury is that it's actually pulling out emerging market interest rates. And you see countries like Indonesia, Philippines, Turkey, all raising interest rates. I think the worst was Turkey. They raised like 3.5 percentage points in interest rates. This will restrict global growth. So of course, when interest rates are high, it's going to affect demand. And the weak currency is also affecting commodities. And so soft commodities, being like companies like Olam, Wilmar, all these are going to be affected when you have high US dollar, because it will make commodity prices more expensive in local terms. So that's also another negative, not to mention the higher interest rates. Just to recap, for Singapore, the latest data still show hospitality robust, but property transactions sluggish. And just to give a narrative on China Aviation, like what Peggy said, we like it because there's very clear visibility of the return of the Chinese tourists. And even before that, jet fuel demand, like Peggy mentioned, was already growing 8%, and the valuations are attractive because almost 2/3 of the company is all net cash. But in terms of the events, we have, I think you can see here, the key ones is of course the FOMC, and then you have US payroll numbers. And then in terms of the corporate webinars, which we title them as corporate insights, no longer guest presentation, but namely all REITs actually, like I don't know how many REITs here, but I guess one of the more interesting ones would be, of course, a Manulife REIT coming on 3rd November this week. On Friday, I think. Next slide. So in terms of residential production transaction, you can see that it's clearly coming down, continues to slide after the cooling measures. This is just to show how much inventory there is in the residential market for new launch. The blue line is the unsold homes. That doesn't mean they have been launched but unsold, but it's just some of them are not yet launched, some of them are already launched, but this is the inventory. So it's quite stable, near the lows of 15,000 units. So it's not like a lot, but in terms of their rate line is just to show based on the run rate of selling, because sales has been very weak. So sales is about probably 6,000-7,000 a year. So compared to the inventory, 16,000. So that's how you get roughly around 2.8 years of inventory. Next slide. It just in conclusion, the property market is not robust. I mean, just after saying so much. The other thing is the inflation. So the important one is the rate line. So the Federal Reserve want the rate line to go to the green line, which is 2%. We think it will narrow down quite close. So by the middle of next year, we think you could hit 2.5%. Based on the trend lines, a month-on-month trend line. So that's why we still think that there could be a rate cut by the end of next year. Next slide. Then the final one, I know there's this very busy line. So this is how the Fed funds, the market was pricing the Federal Reserve, whether they're going to raise rates or not. So in June, you can see that in June, the market was expecting rates to drop very sharply to maybe 4.1% by December. Then because of then August, it started to climb. But when the September meeting, you see this very big spike in expectations. I think we mentioned before. So that's why the bond markets are affected. The numbers you see here in the middle, +4, what it means is that the bond market is expecting Federal Reserve rates to rise by 4%. Basically, no change, I mean. So they are not in November, the market is not expecting any rate hike, neither are they expecting December. Then they're starting to price in rate cuts from second quarter. I don't think so, but anyway, that's what the market is pricing in. Just for your reference. So as the title suggests, market is pricing in 3 rate hikes in 2024, just for information. I guess it's going to be important for REITs, how you view REITs. Yeah. Okay, I think that's my last slide. I think I can move on to Q&A. I think, yeah. Okay, thanks everyone for your time.
Yeah, maybe I'll just take the first few questions as for the banks first. Okay, so it says Glenn Stanchart, HSBC, Xpetra all reported increasing LP, I think NPAs related to China property and China/property. Also, their stakes in China banks, Chinese banks, impairments. Do Singapore banks face similar risk? Yeah, that's a good question. So in the last, I think last week or 2 weeks ago, I did talk about briefly about how what are the local banks, the 3 local banks, Greater China exposure. So I mean the main thing I would say is that the Singapore banks have a smaller exposure. So Singapore banks, roughly, if you look at their loans alone across the board, average of around 23%. Even their profit, it's around 16% of their profits to Greater China. So that includes Hong Kong and China. So if you look at let's say Stanchart, for example, majority of it comes from Hong Kong and China. So the split is quite different. So I think that's the difference between the local banks and like banks such as Stanchart and HSBC, where our banks, Singapore banks they look more into Singapore as well as the ASEAN region. So, in the surrounding countries around us, like Indonesia, Thailand, Malaysia, etc. Yeah, so I don't think they face similar risks. Definitely there's risk. So if you listen to what I was talking about UOB earlier, they did, preemptively increase their provisions just because of what's happening, not just in China, but also China, Hong Kong, but also in the US. So they did increase their specific provisions. We might see something similar for DBS and OCBC, but it'll be quite hard to say. I think they will just have to wait for their results. Yeah, so I don't think they face similar risks, but yes, they definitely do face a risk in that segment and that sector. So I think going to the next question, someone asked, this is a quick one. Someone asked, may I know when will OCBC and DBS announce their results? So yes, sure. DBS is on 6th November, so it's next Monday, where OCBC is on 10th, so that will be on a Friday. Yeah, it's before market opens. I'll put it inside I'll answer the question, so it will be there. Okay, next question. DBS has come down. Is it a good time to buy? Is there a new price target? No, our target price has remained the same. It's at $41.60. Is it a good time to buy? Yeah, if you look at DBS, the positives of DBS, it's, I guess, roughly similar to UOB. I think the first one being that they do expect a fee income increase as well. We just have to wait for the results to see how much they did say for 2024. But they also did acquire Citibank, so in Taiwan, so that would be a boost to their fee income and their wealth management. Yeah, and I think rates also will roughly maintain at the same levels. But I think more importantly, it will be how they do their loan book and whether they are able to increase loans maybe to mid-single digit levels or even high single digit. But I think we'll be looking at somewhere between low to mid-single digit for DBS. I think why DBS has gone down, it will be quite hard to say, but it might possibly be the previous sort of IT disruptions which they had. But I think it'll be quite interesting to listen to the call or give an update when they do have the call and see what they say, what actually happened. Yeah, so I'll give a further update when the results are out, which will be on 6th November. So one more question about UOB. Why UOB prices keep declining after their recent earnings report? Sell on news? Yeah, possibly. Another thing is that because it might be a reason, might be due to their quarter-on-quarter sort of growth. It's not as positive as their year-on-year. So year-on-year is still growing quite well. But if you look at a quarter-on-quarter, it's quite flat. The only thing that has shown positivity would be their fee income, where it grew by double-digit. But if you look at their NIMs and their net interest income, it's all quite flat. And the only thing that I think the earnings were affected is mainly due to the one-off, the Citi acquisition expenses, the one-offs which they call it, as well as the increase in their specific provisionings for the preemptive move which they made. So that might be that's the only 2 reasons I can think of for UOB. Let me just double check whether there's anything else. Yeah, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
there's one for me. Maybe I do that. Peggy, CAO, your sharing of is TP of $1.01. What range of oil price you are considering? It, at least need stay above $90 or US $85. The thing about CAO is they actually earn a fixed dollar spread above their cost, which means whatever the oil price is, the value that they source it in, they add on their margin and then they sell it at the ASP, which is cost plus the margin. So whatever the oil price at which they secure does not have a direct impact on their profitability. So it's a volume gain. The higher the volume, the better the profitability for them. The indirect thing I can think of for a high oil price is that if jet fuel price stays too high, you get some of the airlines who are not able to absorb this kind of cost level to drop out of the race. Like for instance, lately we heard about my airline closing shop in Malaysia. So if they have airlines that could not survive or that have to be full, then there could be a decline in demand for jet fuel. So that there could be an indirect impact, but not so much of a direct impact. The other impact from jet fuel from price point is that if the price is on a rising trend, then CEO might be able to benefit from a contango situation, whereby the forward price is higher than the spot price. Then they can take advantage of the storage capacity that they have at their associates. They have two associates, one is in Korea, one is in China, that has a storage capacity. So they can use their balance sheet and their strong liquidity position to take advantage of this kind of situation. So for my projections, the oil price was not one of my key assumptions in my earnings model. Thank you. Thanks. I pass on to the rest.
Thank you, Peggy. Let me take on a few questions with respect to Microsoft. What is Microsoft's target price? So currently we have a target price of $375 on Microsoft. And another question was, can you share with us the rule of 40 for Microsoft and Amazon? So for Microsoft, based on a 3-year average revenue growth rate, which was about 14% and EBITDA margin of about 48%, we have a total of about 62%. So which meets the threshold requirement of 40%. So and that's all for Microsoft. Would now like to pass on to Max for Amazon.
Yeah, thanks, Ambrish. But so for Amazon, if we calculate based on FY22 numbers, the 3-year average revenue growth will be 23% and the EBITDA margin will be 11%. So the total is about 34%, which means that it fell a bit short of the rule of 40 framework. And the main reason for this is probably because of the lower margins that the company experienced recorded during the 2022, especially when after they experienced such a growth, and which is why they started to do the efficiency enhancement initiative starting this year. Hope that answers your question. Thanks.
I'd like to take this answer. A quick question on what is it? Yeah, just now I think we shared it $375 US dollars. So we actually increased it to 160. That's all for. I'll hand it back to you.
Yeah, let me take some questions. Yeah, there's one saying kindly comment on the maturing debt in 2024 that is still not refinanced for Mapletree Lock, Mapletree Industrial, Frasers, Centrepoint Trust, Frasers, Lockcom, Ascenders, Escort, the Capital, basically all the Mapletree CapitaLands and the Frasers REITs. Yeah, so I actually have a list table that I tallied inside the REIT monthly previously, but I can just say out some of the percentages. So for the maple trees, basically they have about 15% of the debt maturing in 2024. So FCT they just announced that they refinanced the FY24 loan. So that is no more loans that's up for refinancing. Frasers lock their is about 25% next year. But their results are coming out soon, so yeah, they will have some updates there. Other than that, Ascendus is also about 15%, and so is Escort is around 19%. Yeah, CICT also 15%. Yeah, so those are the numbers. And yeah, so when they refinance these loans, we expect the interest rates to rise also, like the finance costs. Yeah, cause back then, when they had structured the loans were probably at around 1% or even less than that. So now let's like for the local loans, the SORA has really risen to about 3.6, 3.7%. So yeah, we expect that about 200 over basis points increase. Yeah, and then there is one, actually there are two questions on CapitaLand investment. So one is asking why is share prices trending down, and there's one more that's specifically targeted to Paul, so that one I'll leave there. And then I'll try to answer the first one, which is a lot of the share price correction for CLI is basically in line with the STI. So the STI also is down about 5%, and so is CLI. But we note that CLI, they are affected by the high interest rates, because interest rates, they affect CLI in a few ways. Like, because their business is, a part of their business is to generate transactions, like they get fee income from doing transactions, as well as getting divestment gains and the capital gains on capital recycling. But then because of the high interest rate environment, is very hard to do all these transactions, and there are basically very few transactions happening in the market. And it's also very hard for them to raise funds in a high interest rate environment. So these are two of the biggest headwinds for them. Like we saw in their most recent result that basically they did not have any divestment gains in the first half. So we expect this weakness to continue going forward, but we think it will start to improve as there's more clarity on the interest rates movement. Like interest rates likely have peaked, so the performance and transactions is easier for all these investors to start planning to make these acquisitions. So yeah, we think transactions will pick up, and as a result, they might be able to, CLI might be able to make more transactions and make more gains on their portfolio, as well as fees from all these transactions going forward. Yeah, but the weakness in share price is basically, in our view, is the higher for longer interest rates. Yeah, I'll leave the other one for Paul to answer. Yeah, I think that's all for me. I'll pass the rest of my colleagues. Thanks.
I will just take the Hong Kong line and pass it to Miao. But so for CapitaLand investment, you must think of them like, I think from my own view, I'm not covering the stock, but you must think of them like a private equity fund manager, which they are which the revenue model actually replicates that. So they will make money when there's transactions happening, and in a way, and also they will make money when the assets under management grow. So the ability to make money from transactions is down because of the high cap rates. So these days it's very hard to buy or sell any commercial property because nobody knows when interest rate is going to land. So until interest rates stabilize, then you will probably see transactions coming back. But the key measure for us, why we like it, is that like we highlighted before, because they have this very unique model from cradle to afterlife. And that means they can take an empty piece of land, they make one round by developing it, then make one round from renting it out, then make another round from selling the property, then make another round from the same property by managing it as a REIT or whatsoever. But the key barometer to measure is their assets under management, which I don't have the number, but I think it's still growing. So that is the core thing. Assets under management that shows that the business franchise is still building. you get this volatility of the income moving up and down transactions. The other key barometer is probably one of the big jewels inside there is their Somerset service apartment. So that also continues to grow the keys. So these are the foundation of the whole business. Is the assets under management and the keys under management for the Somerset business. So long as that continues to grow, we are still comfortable. The outlook is good. But of course, the environment now isn't great for such a business. Yeah, okay. It's a very long answer, but anyway, that's my own view. Yeah. Mel, you want to take some?
Yes. Let me take the between CapitaLand Escort Trust and Far East Hospitality Trust. If you can put into only one counter, which one would you consider and why? So for CapitaLand Escort Trust, they just released the third quarter to 3 result updates. Gross profit was up 23% year-on-year, and RevPAR is at 102% of pre-pandemic level. And their dividend yield is about the same as Far East Hospitality Trust, about 6%. And balance sheet looks both robust, gearing at 35%-ish. But Far East is pure play Singapore, and CapitaLand Escort Trust is a very diversified portfolio across Europe, US, and Asia. And in terms of the growth potential, CLAS is probably better. They just divested 4 mature assets in France, net proceeds of 34 million euro, and priced at 33% above book value. And they also acquired a 500 million asset in LA. And there's 3 more acquisitions to be done, and it's already approved. And given the time lag of the completion of the acquisition, we expect the DPU to be neutral in FY23, but then will be accretive in FY24, around 1.8% DPU accretive. Yeah, hope it answers your question. And what kind of government contract is Village Hotel Avocado entering into? This is just like they want to have a place for some COVID cases and other like infectious diseases. It's just a part of the standardized healthcare provision of Singapore government. And for hospitality sector, which one is better, Far East Hospitality Trust or Frasers Hospitality? Is it a good accumulate now as the share price has risen? For Frasers Hospitality Trust, we don't cover it, but their third quarter result hasn't out yet. But observing the share price is probably going to be good. And the RevPAR for second quarter is already at 115% of the pre-pandemic level. And given there was a huge influx of Chinese tourism in the second half to 3, yeah, we expect the RevPAR in third quarter continue to trending up. Yeah. Hope it answers your question. Yeah, that's all for me. Thank you.
Yeah, and just to follow up, the government is, I mean, I'm also surprised that the authorities still have still surprised that the authorities still have these hotels, but it's mainly for, according to the company, say it's mainly for tour groups that come into Singapore and they're not vaccinated, so they're just a bit mindful of that. So I'm not sure. I'm not particularly sure, but actually that's why these hotels in Orchard Road are still, or Albert Court, sorry, is still under government contract. But the good thing is the rates are higher now because they're not losing out because the hotel room rates are up. So actually they also still benefit from higher repricing of these contracts to the government. Why is Phillip target price always on the higher side as compared to? Actually, I'm not sure why. Actually, I don't really look at when we do. We just try to be as objective as possible. We don't really look at other people's target price. Yeah, maybe our assumptions are more aggressive, but if that should be the only reason, and not so much whether we follows. So let's say for the banks, it's just maybe our ROE is more aggressive than the rest. And our assumptions are more aggressive, so that could be one reason. But we typically don't really look at peers when we come to it. this CapitaLand, I think if it's answered, can you all just put answered? Yeah. Will carbon tax affect the profitability of consumer stocks like Siong through pass-through electricity? I'll just give you my take. Maybe I'm not sure if Peggy has anything, but for the carbon tax, it mainly affects the Gencos. It will affect Siong and affect all of us here in the call indirectly because all the big power producers have to pay. When you speak to corporates, generally they are a bit wary, so they are concerned that because the carbon tax is only for the large emitters, and I think there's going to be a very big jump in carbon tax in 2024. So just to answer again, it doesn't really affect directly but indirectly, but thankfully I think they renegotiated utility and it should be coming down quite significantly next year. But it's affect indirectly. Directly so far nothing. But maybe that's why also most of the corporates are a bit more aware of ESG now. Apart from doing good to the planet, I guess. But the other thing is also they're just want to get ready in case carbon tax keeps on filtering down to corporates. There's lower emitter to almost everyone. Yeah. Okay, Paul Sheng Siong, did you factor in the business operations in China on our target price? If yes, would you see its China operations being more positive or negative? Okay, so when we do our valuations, we just take and block the whole profit. So China is probably not in there because China's profitability is still very small. They have 6 stores in China now in Kunming. They're only going to stick to one province. So just a few key points since we're on this topic. They want to grow. I think at least they need to grow 30 over stores to be scalable. Scalable means I think it's only at this number of stores will you be able to have a distribution center. But the challenge they face now is that most of the money, most of the profit, it comes from fresh food. But the problem is that the modern retail concept in China is still new. So most people are still shopping in the wet markets. So maybe this is like Singapore, I don't know, maybe 20, 30 years. But you know, Sheng Siong playing a long game here. So it will take time for them to build up this franchise. Then one last point, just for info purpose, I think when they went into China, they thought they would bring in, because Singapore brand, foreign goods, but they realized that doesn't work because these are not essential products. So now they changed strategy, I think a few years ago, to focus more on local products where it become essential, and then people can go in and shop regularly, something similar to what they're doing in Singapore right now. So, but that's why it's a long game for them. Yeah. Okay, what is the significance of Singapore housing market in the overall Singapore economy? I don't have the exact number, but for the banks especially, I think probably Glenn can give you a number, but the housing market is very critical. I think most of the collateral, maybe 40% of all the loans come from housing. And I think it's a bedrock to any economy. I think not only just Singapore. So the weakness in China that you see does affect not only the industries, but also affect the collateral values of a lot of banks. So I don't have the exact share, but of course it's going to be very important, just purely on the banking system alone. And any comment on Hong Kong land price? So the weakness in Hong Kong land is mainly because of the first half. You notice the vacancy rate in Hong Kong spiked up. So as what Darren mentioned, I think office vacancy in Singapore, most of the REITs here probably, I don't know, 98, 99, almost like full occupancy, maybe some temporary closure before they wait for a new tenant. But the vacancy rate for Hong Kong land alone is about 7%, 6 to 7%. So that means they're only 90+% filled. And for the whole Hong Kong Central, it's probably like 90% occupancy. So you notice the difference between Singapore and Hong Kong. So that's why it's plaguing the Hong Kong land. And also Hong Kong land also does property development in China. But I think that one is still fine based on the results. But these are the two overhangs they have until people see some clearer signs that the vacancy rate, office vacancy rate in Hong Kong is improving. And you can imagine this is the central Hong Kong. No? This is like CBD Hong Kong. And the vacancy is really rate so high. So outskirts could be even worse. But anyway, maybe things will improve as we move along. But I have no view. I have no idea what's going on in Hong Kong. Yeah. Your year-end STI projection below. we don't, as you notice, we don't really give STI projection, because actually, if we actually talk about STI, the FTSE going to charge us 20,000. Because if we mention anything on STI, there's a licensing requirement. They want to charge us 20,000 if we talk about STI. So we cannot talk about STI. Nobody even talks about. Next time, I cannot talk about Singapore market. But anyway, we don't give a projection, but we think it's just going to move sideways for us for the STI. But you notice most of our reports, we don't mention STI because there's a licensing requirement. Yeah, not that Singapore market is that popular, but also they still want to charge us 20,000. Can you comment on ComfortDelGro? So we think the third quarter results will be very strong. I think that's our own view. Like we mentioned before, because the UK will recover, the taxi in Singapore will recover, China taxi rebates also will recover. So we think there's a lot of positive tailwinds for Comfort in the upcoming results. I do one next one. Before I pan over to the rest, Paul, Propnex share price further corrected. Worth a accumulate now for long term. Yeah, I'm a bit just that the dividend is still going to be strong, but just that the weak data that we see for transaction market is going to put some weakness in the results. They will still capture shares, so it won't be as bad as you saw in the third quarter, 15%. So it will still be down, I think, in the second half, but it won't be as bad as the market because we think they can capture market share, and this is transaction volume. It doesn't include the price. So maybe if you assume another 3-4 percentage point increase in price value, so they might still be down like one single digit. But they're still, Propnex still has a very incredible business model. I mean, they make like, I don't know, 50 million, 60 million net cash, 150 million, no fixed assets. It's still a very strong business. Just that in the very near term, if the fourth quarter don't see any improvement in the transaction volumes, then we're just worried that the second half results could be weaker than expected. I mean, the data is there, so can't, yeah. Okay, I hand it to the rest because I think a lot of this REITs and yeah.
Yeah, thanks, Paul. Maybe I'll just take that one on the housing, right? Yeah, just to reiterate, just to add on to what Paul has said, yeah, he's right. So if we look at DBS, so they only released this like details of their loan book like in the first half. So every half they will only release these details. So just take DBS for example as a proxy. I think they have around they currently have around 20% of their loans is in housing loans. And we also have access to MAS data. And if you look at MAS data, this is overall, right, for all the banks. So it's around 28%. Yeah, so you're right. The housing market actually does have quite a large share of the overall Singapore economy and the market. Yeah, so around 1/3 of it is in the housing market. Hope that answers the question. Thanks. Hand it over to the rest. Thanks.
Yeah, I think for banks, just to add on, the key question we always get, I think the key question to ask is that, once interest rates come down, what is the impact to the bank earnings? So for us, we think there are some offsets, because if interest rates come down, then of course we'll never be clear whether this can offset the weakness if interest rate come down and then NIM maybe drop a little bit. Is what can offset the weaker net interest income. So we think it could be fee income, because if rates come down, then wealth management products will be more stable, because rates are land, then there could be better income there. Then loans growth could also pick up when interest rates come down. And also you could get mark-to-market gains on their book. So the book value could actually climb back up. Because you don't see in the UOB results, but there's like 200 million of mark-to-market losses. That's why the book value actually came down, even though earnings was up. Of course, they paid dividends too. But so these are the 2 or 3 offsets. And if interest rates come down, then the dividend yield of 6% will also still look attractive. Yeah. So there is offset. It doesn't mean Boeing is going to enjoy like stellar growth, but it's not going to like collapse if interest rates come down, because there are some offsets to the income statement. Yeah, okay, I hand it over to you, Darren.
Yeah. I believe that the locally listed US office REITs borrowed from local financial market. Its financial experts here, I suppose. Yeah, so Manulife and Keppel Pacific, most if not all, but a bigger majority of the portion is from local banks. But for Prime, most of their loans are actually from overseas banks. Yeah, so yeah, it's mainly the local for Core and Manulife is mainly the local banks, yeah, and Citibank if I'm not wrong. Yeah, but I don't have the details on hand right now. Then hospitality REITs are enjoying great results because the tourists keep traveling worldwide, especially to Singapore. When this referral dies down in the future and RevPAR goes down, won't hospitality trust start to do worse and unit prices may reverse? Yeah, so for this, right, we still see, yeah, we do know that this quarter's results actually, because of the higher base, right, the year-on-year performance has kind of slowed from the first half, because first half 2022, it was still quite weak, the travel recovery. So for first half 23, the year-on-year performance was quite high, was much higher than the year-on-year performance for so far this third quarter. But the thing to note is that right now the average daily room rates are already at all-time highs, and the occupancy is still lagging behind pre-COVID levels. So there's still actually this room for RevPAR to grow forward. And we also note that RevPAR is highly likely the growth will slow down next year as well. But we still see a growth potential for RevPAR going forward. And so this will help to boost the DPU, the dividends. And so for your question, wouldn't hospitality trust start to do worse and unit prices may reverse? Yeah. Personally, I don't think so, because the RevPAR will kind of maintain at the high levels, and the rents that like from master leases as well as management contracts, the revenue will keep will keep growing by a slower pace. So I don't think they will do worse, as in their revenue will decrease, or yeah. But for the unit prices, hard to say, because that is a share price performance. It's hard to predict that. So yeah, but for operational performance, like on the revenue line, it's hard to see it doing worse year on year going forward. So per se, I still think it will continue to increase, but definitely at a slower pace because of the higher base. Like, cannot expect a FY24's RevPAR and revenue growth to be as high as FY23's, because FY23's base is really quite high compared to FY22. Yeah. So for CCT, leave it to Mel. Thanks.
Thank you, Darren. Yeah, I'll take CCT. Recent result, is it good? Price have gone broken support after support. How is the gearing and refinancing schedule? So for third quarter Q3, the revenue decreased by 1.9%. Due to closure of a shopping mall, and then 3 months rental provision for a tenant in Shuangliang Mall. And retail sector outperformed pre-COVID level, and occupancy rate at 97.8%, rental reversion of 2.8%. There was very strong demand from F&B, and also like gradual recovery from entertainment sector. The main drag was from business parks and logistics. Yeah, still underperforming pre-COVID. But business parks, the overall occupancy rate still at 90.8%, and positive rental reversion of 2.9%. It's just like Hangzhou and the south part of China, there's weaker activity in the e-commerce sector. And so like CCT is shifting the focus towards electronics and also biotechs. Yeah, and also like there's more favorable government incentives given to the two sectors. And yeah, we'll see like rental reversion in the near term continue to be under pressure for business parks. And then for logistics, I think there was like negative rental reversion. And then CCT is also shifting focus away from e-commerce and 3PLs. Yeah, and gearing was at 42.4%, cost of debt 3.55%. they don't have any refinancing needs till 2025. Yeah, and for end-year valuation, they will have like some asset-specific pressure, and overall the decline should be around 1.5% in general for the year-end valuation. Yeah, hope it answers your question. Thank you.
Maybe I take over from here. There's a question on C-Trim. Any update on C-Trim? Not much update from here. They will announce a third quarter business update on the 8th of November before market open. Usually in third quarter updates, there's not much financial details being provided. So we don't see, we'll probably be asking them on the progress of their operational review after they took over the Capital O&M, what sort of changes that they're implementing, or any rationalization, restructuring, or cost cutting. Yeah. The one thing to note is Capital has a stake in C-Trim after that share swap. So Capital's stake right now in C-Trim is about 2.069% stake, and they have always been in the market cutting their stakes in the market. So yeah, so the weakness from the share price could be from this. Otherwise, not much news on C-Trim. On the point about carbon tax, Sembcorp, both Sembcorp and Capital told us that the increase in carbon tax to $25 per ton from 2024 and 2025, and to $45 per ton from 2026 onwards. All this increase, they will pass it on to their customers. But note that this carbon tax is only imposed on those users who are emitting 25,000 units of GHG per year, greenhouse gas emission per year. So it only affects the big emitters of carbon. So and that in the agreement, is in the imposition of this tax as well, these emitters are also able to activate some carbon mitigation solutions. So if they can have some solutions to offset the carbon emission and cut it down, there's some offsetting factor that will reduce their carbon tax liabilities. So there are various ways available. So the flow through to the end users, to the smaller emitters, smaller users of energy are probably less, and the impact for the smaller users might be much lower than the impact is much smaller than this jump that we see. This five times jump might not be what the smaller players will face. Yeah. I hope I answered that question. Yeah. Thanks. I'll pass back to.
Yeah, just a quick one. Any update on UO REIT? Yeah, so UO REIT, basically their shares have been suspended for a few months already, and the main issue is because their sponsor, Fortune Holdings, yeah, they defaulted, or rather they owe UO REIT rents, but they have not paid. So because of that, UO REIT, they are unable to finance, or rather they pay off the interest on their loans, so they've defaulted on their loans. So as a result, their shares have been suspended. And the most recent update is that they were supposed to sell 2 logistic assets to the sponsor as well, which is the same holding, the Fortune Holdings. But the sponsor was unable to get the refinancing for these assets. So as a result, the deal fell through. Yeah, so things are not looking too good for UO REIT. Yeah, of course, mainly, yeah, they need to pay off the loans, but yeah, of course, the sponsor, they are not, they still owe the REIT money, but they're not paying, so yeah, they're in some financial troubles there. Yeah, so that's the latest update. Yeah, I think that's all. Just yeah, there's question on Cecil and iFast Capital. Not sure if anyone wants to answer that. If not, we can start to end this session soon.
I'll take the Cecil rate question. Cecil rate, the result will be on 7th of November or 8th of November, if I remember correctly. There's no recent updates. We had our set visiting last month to Chongqing, Liangjiang, and Xi'an outlets. So they're acquiring Xi'an outlet. I think will be middle or early next year, and this will be DPU accretive. And the Sasser, now their sales looks healthy. We expect the full year sales to increase by 25% year on year. And yeah, we'll keep you updated once their circular result is out. Yeah, thank you.
But when you're there, in your report you mentioned, right, the tenant sales. What did he say?
Yeah, let me pull up the report.
Yeah, and for iFast Capital, sorry, we can't really mention much about it because it's our sister company. So, and we're not very familiar with the company actually. Sorry, no, we're unable to do any TA today because Zane is on leave. Forward Singapore exercise, what sectors will likely benefit? I actually not sure myself. I was reading it through. I was just trying to figure out what sectors will the government be spending extra. So, but I don't have any answers, so I'm not very sure myself. Yeah. Amel, you want to go on? And there's one more on the chat here. Any update on Del Monte? So Del Monte is still flushing out their high cost inventory. And I think they'll probably take another 1 or 2 more quarters for them to clear the high inventory before their margins start to recover. Miao, you got, yeah.
I'll continue the Cesar rate. Also, they just ended the annual anniversary sales, and the sales for the next past 9 months has already outperformed the entire year of FY22. And we see like there's a pending up demand in China, and also like there's consumption downgrade. So consumers usually will tend to prefer the more like value products, such as the outlet products in Sasser. And also like VIP membership at the risk level increased to 3.2 million, and it actually accounts for 70 to 80% of the overall sales. Yeah, and also like Sasser is continue enhancing their VIP base. And also for the acquisition in Xi'an is expected to be DPU accretive and raise DPU by 4%. And gearing now is only at 26.2%. So they have a debt headroom of 800 million Singapore dollar. Yeah. And we anticipate a full year of 29% year-on-year increase in sales. Yeah, that's all for Sasser rate. And also like now it's trending at a dividend yield of 10%. Yeah, for Sasser. Thank you.
Yeah, thanks, Mel. I think the main negative is just the RMB. I think that's going to be the biggest issue for them. Yeah, Mel, I got one more. Can you like the interest rates? Yeah, then we end it.
I think, yeah, the interest rate for Sasser after refinancing is 5.5. Yeah, going forward, because onshore loan, the rate for onshore loan is decreasing, and they are also like rebalancing their onshore and offshore loan, the mixture. And going forward is expected to maintain at around 5.5%. Yeah.
Okay, with that, thanks everyone for your time. Do look out for all our webinars. I think we quite a lot. I think this week we have 3, which is Wednesday, Thursday, Friday, ESR, Paragon, and also Manulife on Friday. With that, thanks everyone for spending your time with us. Hope you have a good week ahead, and thanks again for all the questions and your time. Thank you, everyone. Take care.